Hello, and welcome to myfinancesteacher.org. In this video, I want to have a quick brief look at gold and the general stock market, S&P 500. And I also want to introduce something new, a new interesting indicator that we will look at from now on to help us choose an interesting entry point on a range of assets. Before we continue, let me remind you guys to subscribe to the channel if you haven't and click that bell notification. Thanks a lot. So stay tuned for that, but for a moment I want to start with a shorter term view of gold. Looks like gold is in an ongoing short-term daily cycle that has been going on so far for 35 days already. And since usually these cycles last for only about 1.5 to 2 months, I think there is a pretty good chance that gold might actually decline from here. That is, if gold fails to regain that, let's say, magical $1,800 number. If gold stays below that number, we might see gold decline over the next couple of weeks to give us the short-term daily cycle decline. That also kind of agrees with this poke above the upper range of the Bollinger Bands, which often precedes some sort of a decline in price, and also a poke into the oversold level on the 14-day RSI. So that I think is quite likely. Although if gold stays strong above $1,800 early next week, then that actually might attract more speculators into the precious metals, pushing the price higher before that drop into the short-term daily cycle low comes a little bit later, maybe stretching this short-term cycle into 2 months rather than, let's say, 1.5 months duration. So in my own positions, as I mentioned to the members at myfinancesteacher.org, I'm still holding a relatively large position, but I am holding them with also a relatively tight stop loss. So if gold continues even just a little bit down early next week, I might be thrown out from a lot of those positions, which I actually would be fine with. Even if I don't manage to catch another poke higher towards the higher 1800s, it's fine. The intermediate cycle is already 112 days long, so it's possibly going to decline over the next couple of months, as usually these cycles last for about half a year. By the way, we're going to look at an intermediate and longer term view in a minute. So if I'm actually going to be thrown out of my positions due to relatively tight stop losses early next week, again, I'm fine with that. We will look for the next entry opportunity at the end of the ongoing intermediate cycle. Next, let's have a look at that intermediate and longer term view. This is the chart of gold price since like middle of 2013. And generally what I want to emphasize here is we often observe cyclicity in gold price. That's why I really like to look at gold cycles. And the first insight that I just want to take from this chart before moving on to the new indicator we're going to consider is average duration of these gold cycles. As we can see, between the middle of 2013 and the early part of 2020, we have
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14.
That's 14 cycles in just under 7 years, from the middle of 2013 to March of 2020, just under 7 years. So on average, these cycles last for just under half a year. Let's call it half a year. So from this, I want to move into the new indicator we're going to look at from time to time at myfinancesteacher.org, which is a 25-week return, where 25 kind of refers to a half a year period. A year is 52 weeks, half of that is 26. 25 is a bit of a more of a round number, maybe, so let's look at that. The actual lines don't really change that much if you use 26-week return instead. So the red line on this chart is this 25-week return. That's the return that you would get if you had been holding gold for 25 weeks prior to that. Blue line, of course, is gold price itself. What we see here is the return generally fluctuates somewhere between negative 20%, sometimes as low as negative 28%, and positive 25%, where negative 28 and positive 25 are kind of an extreme numbers over the last 8 years or so. So it's more common for the return to fluctuate somewhere between negative 15% and positive 18%. Now matching this red line, the 25-week return, with the gold price and what we've learned about cycles from a lot of my previous videos already, you can see that along with a lot of other indicators that we look at in this channel and at myfinancesteacher.org, this can be yet another indicator that can help us to identify a nice entry point. As you see, generally when the 25-week return is somewhere around negative 10%, that's often a really good buying opportunity. But sometimes though, especially in the more recent bull market in gold starting somewhere at the end of 2015, a relatively nice entry opportunity might come up earlier based on this red line when the 25-week return is only down to about 0%, as it happened over here in the middle of 2017, then near the end of 2017. The mid-2018 decline was a really stretched one. To be honest, that was a little bit painful to wait for the low. I started accumulating gold when the price was quite above the low at about 1240. But we still managed to get some returns into the rally of the next intermediate cycle. So one insight from this chart is that a nice entry point on gold might actually come when this 25-week return is somewhere at about 0% or into negative. Another insight is what's happening to gold right now. Well, the 25-week return is somewhere close to 15% at the moment. By the way, I forgot to mention that the scale for the red line is on the left axis, whereas gold price, of course, is on the right axis here. So moving on from here, yes, back in 2016, the 25-week return did shoot up to 25%. So if gold stays above 1800, if there is a lot of speculative demand because of this phenomenon of gold staying above 1800, then yes, that can actually lead to substantially higher gold prices, and maybe the 25-week return might actually shoot up as high as 25% or so. But on the other hand though, do you want to jump in from here with a lot of allocation? Well, probably not. And even if you do buy with the gold closing above 1800 with the hope of that speculative demand, in that case you probably want to have relatively tight stop losses, as this indicator is nowhere near negative or even zero. So that is your second insight from this chart. Next, let's move on to the general stock market. This is S&P 500. Unfortunately, here on Thursday, I was thrown out of my position in the general stock market, and it turned out just to be a long wick, with Friday actually giving us a nice green candle. Well, that's okay. It can happen sometimes. I'm actually pretty okay with that, even though it looks like the ongoing short-term daily cycle is only 11 days old, and as these usually last for about a couple of months, there might be actually at least a couple of more weeks of upward momentum in S&P 500. Although there is also a small chance that the short-term daily cycle is still ongoing from the middle of May, in which case the ongoing short-term daily cycle would be on day 57, meaning that it's due for a relatively abrupt end to the cycle with a substantial decline. Again, just because these cycles usually last for somewhere between 1.5 to 2.5 months. But I don't think it's a very likely scenario. I think it's possibly more likely, 65% chance I would say, that the ongoing short-term daily cycle is a relatively young one that started at the very end of June. And I was thrown out of the trade by this long wick, by this short-term blip down on S&P on Thursday. Again, as I said, I am fine with that, and the reason for that is because the intermediate cycle is probably past its midpoint already. It's on day 109, and again, usually these last for about half a year. So I think in another few months, maybe sometime into autumn, if healthcare concerns flare up again a little bit, that might actually give us another intermediate cycle decline into a nice entry point. So that's the intermediate term outlook. With the short-term outlook, this month on the 29th of July we'll have the FOMC meeting, and it looks like the markets really expect no change in the rates. That's of course because last time Chairman Powell said that they're not even thinking of changing the rates. But by the time of this meeting, the ongoing short-term daily cycle will have been going on for about a month, so it would be somewhere into the midpoint of a usual duration. So even though the change in rates is extremely unlikely, if the Fed doesn't talk dovish enough, if they say, okay, we might start thinking about, I don't know, raising rates because the markets are doing so well, then that might actually bring S&P down into the short-term daily cycle decline and possibly later into the intermediate cycle decline, especially if health concerns become an issue. Next, let's have a look at this 25-week return for the general stock markets as well. Again, looking at S&P 500. Blue line is the S&P 500. The scale for that is on the right-hand side. The red line is 25-week return. Scale for that is on the left-hand side. As we see here, because S&P sometimes just keeps going higher, possibly with the support of the Fed, without significant declines into the intermediate cycle lows. That's actually unlike what gold does. So for that reason, sometimes this 25-week return doesn't actually drop far enough to give you a very clear buy signal. But sometimes, around every 4 years or so, a lot of you know about the 4-year cycle in the stock market, this 25-week return does dip down below negative 10%, showing you a very clear buying opportunity. So again, in our analysis, we actually use a range of indicators to help us decide on a nice entry point. For example, here, when you're looking at 25-week return, you probably want a relatively low number, somewhere close to 0 or below. Plus, you want to match that with your understanding of cycles and what's going to happen to the markets on the fundamentals, such as the decisions of the Fed and stuff like that. So a drop of the 25-week return below 10% is generally a really good buying opportunity on the general stock market. And even a drop below 2% or so is often a nice buying opportunity as well. And although at the moment this indicator is somewhere at about negative 5%, we've already actually seen this indicator jump up from negative 27%. So if you are looking to enter into the general stock markets at the moment, I'd really be only allocating small amounts of capital with relatively tight stop losses. And at the moment, I'm actually, as I've just mentioned a minute ago, I'm inclined to wait for the intermediate cycle decline, possibly sometime into autumn, before I enter with more substantial allocation. So if you like this sort of analysis, I would appreciate it if you hit that like button, subscribe to the channel if you haven't. For more detailed and more frequent analysis, as well as for detailed data on my personal as well as fictitious portfolio allocations, which I've only started recently, you are welcome to join us at myfinancesteacher.org. For now, I wish you an amazing weekend, have fun out there, and when you are back on Monday, good luck in your trades.